Taking profits feels smart, but it's one of the biggest reasons most investors underperform. And if you miss just a few of the biggest winners in the market, your returns don't just suffer, they collapse. Most people think investing is about picking the right stocks, finding the next big winner, beating the market. But that's not actually the hard part. The real problem is this: even when people pick great stocks, they don't stay in them long enough. You've probably experienced this. If you buy a stock, it goes up, say 20, maybe 30%. You feel good, you feel like you've won, so you sell, you lock in that gain. And then what happens? It doubles, then it triples, and suddenly you're watching from the sidelines, realizing you got out way too early. Now here's where things get interesting. If you look at long-term stock market data, you'll find something surprising. A very small number of stocks generate a huge portion of total market returns. Most stocks actually underperform the index, but a small group go on to produce massive sustained trends. We're talking 200%, 500%, sometimes even more, which means something really important. If you miss just a few of those big winners, your overall portfolio performance suffers massively. And this is exactly what happens to most investors, not because they pick bad stocks, but because they don't stay in the good ones long enough. The problem is psychological. Selling feels good, you lock in those gains, you reduce your risk, you feel in total control. It feels like the responsible thing to do at that time. But the market doesn't reward feeling safe, it rewards patience, and it rewards being able to sit through uncertainty and stay invested while the trend develops. And that's uncomfortable, because you start thinking, what if it drops? What if it loses the gains I've already made? So you sell, and then you repeat this pattern over time. So the real skill in investing isn't just picking the winners, it's staying in them long enough for the big moves to actually happen. Some investors don't rely on instinct or emotion at all. Instead, they use systematic approaches, not to predict the market, but to remove the urge to sell too early. And these strategies generally follow a very simple principle. You cut losses quickly and you let profits run. No guessing, no reacting to emotions, just a consistent set of rules applied over the long term. One example of this is trend following. It's a strategy specifically designed to stay invested in trends as long as they continue. I actually broke this down step by step in a previous video, including exactly how it works and how it can be applied. So before you go looking for the next stock, ask yourself this: are you actually giving your winner enough time? Because in many cases, you don't need more fresh ideas. You don't need better stock picks. You just need a way of staying in the right stocks for longer than anyone else. If you found this useful, subscribe for more content on systematic investing and portfolio strategies. And if you want to go deeper, check out the breakdown I've done on trend following, and that's where this idea becomes really powerful.